Ever feel like the world of investing is a secret club where the entry fee is £1 million and a degree from Oxford? We look at the ultra-wealthy, the titans of finance, and assume they must have discovered some incredibly complex mathematical algorithm or had a massive inheritance to kickstart their journey. But the greatest investing story in human history defies all of those assumptions. It belongs to a man who started with a paper route, bought his first shares at age 11, and went on to build a financial empire worth over $100 billion. His name is Warren Buffett. The untold truth about his history isn't just a collection of fun facts. It is a masterclass in how the core mechanics of wealth accumulation work. Today, we are breaking down the exact historical blueprint of the Oracle of Omaha, translating his lifelong strategy into actionable pillars you can use right here in the UK to build your own financial fortress. No Wall Street jargon, just the raw, compounding truth. To understand how Buffett built his empire from nothing, we have to look at the first pillar, his obsessive early entrepreneurial hustle. Long before he was a billionaire, Buffett was the ultimate side hustler. At just 6 years old, living through the Great Depression, he bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and resold the individual bottles to neighbors for 5 cents each. That is a 20% profit margin managed by a child. By his teens, he was running multiple paper routes, sourcing and reselling used golf balls, and even buying broken pinball machines for $25, repairing them and placing them in local barbershops to generate passive income. By the time he finished high school, he had amassed the equivalent of tens of thousands of pounds in today's money and used it to buy 40 acres of farmland to lease out to a local farmer. The lesson here for any modern investor in the UK is profound. Your primary investment engine is your ability to generate surplus income. Buffett didn't wait for a high-paying corporate job to start building capital. He maximized his earning potential through sheer relentless activity. If you want to fund your own ICER or investment account today, you need that same entrepreneurial mindset, finding ways to sweat your skills and create extra income streams. Once Buffett had built his initial pile of cash, he moved to the second pillar, mastering the rules of value investing. This didn't happen by accident. While studying at Columbia University, Buffett met his greatest mentor, Benjamin Graham, the father of value investing. Graham taught him an operating system that completely flipped traditional market thinking on its head. He taught Buffett to stop viewing shares as squiggly lines on a chart or tickers on a screen, and instead view them as what they actually are: fractional ownership in a real, living business. Graham's core philosophy was simple. The market is a manic-depressive beast. Some days it is wildly optimistic and prices things too high. Other days it is utterly terrified and dumps brilliant companies for dirt cheap. Buffett learned to look for what Graham called a margin of safety, buying a company only when its market price was significantly lower than its true underlying value. A classic early example was the Sanborn Map Company, where Buffett noticed the company's share price was $45, but its underlying investment portfolio alone was worth $65 per share. He was essentially buying a massive map business for less than nothing. In the UK today, this mindset is your ultimate shield. Instead of chasing hype, crypto trends, or volatile meme stocks, value investing teaches you to focus on high-quality, fundamentally sound assets that are temporarily undervalued by a fearful market. This brings us directly to the third pillar, which is the massive pivot that truly unlocked Buffett's billions, switching from cheap cigar butts to compounding machines. Early in his career, Buffett focused strictly on Graham's cigar butt style of investing, buying a mediocre, struggling business at an incredibly low price, getting one last free puff of profit out of it, and moving on. This is exactly how he stumbled into an old, failing Massachusetts textile mill called Berkshire Hathaway. He bought it cheaply, but the textile industry was dying, and he realized he was trapped in a stagnant business. Enter his lifelong partner, Charlie Munger. Munger gave Buffett a piece of advice that changed financial history forever. He told him that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Instead of buying dying businesses just because they are cheap, Munger convinced Buffett to look for companies with a durable competitive advantage, what they termed an economic moat. Think of brands with massive customer loyalty, incredible pricing power, and simple, repeatable business models. This is why Berkshire Hathaway stopped focusing on textiles and started buying giants like Geico Insurance, Coca-Cola, and eventually Apple. They bought businesses that could consistently grow their earnings year after year and reinvest those profits automatically. For everyday investors in the UK, this is the argument for low-cost global index funds within your ICER. You don't need to find individual compounding giants yourself. By holding a broad basket of the world's most dominant, moat-protected companies, you let the global corporate machine compound your wealth for you. The fourth pillar of Buffett's history is the absolute superpower of patience and extreme long-term thinking. This is the part that trips up almost everyone in the modern world. We live in an era of instant gratification, where people open a current account or an investment app and expect to be rich by next Tuesday. Warren Buffett's net worth didn't hit its stride until he was well into his 50s. In fact, over 90% of his current wealth was accumulated after his 60th birthday. This is the raw, unadulterated power of compound interest. When your investments make a profit, and you leave that profit alone, it begins to make its own profit. Year after year, the snowball gets bigger, but the real magic only happens at the very end of the hill. Buffett famously remarked that the stock market is a highly efficient mechanism for transferring money from the impatient to the patient. He has held some of his core investments for 40 or 50 years, completely ignoring the short-term noise, recessions, and political crises that cause average investors to panic and sell at a loss. If you are investing in the UK today, whether it's for a primary residence down payment or a comfortable retirement, you must adopt this multi-decade perspective. Volatility is simply the price of entry for long-term wealth creation. The final pillar of the Buffett blueprint is his legendary operational discipline and simple lifestyle. Despite being one of the wealthiest men on the planet, Buffett famously still lives in the exact same 5-bedroom house in Omaha, Nebraska that he bought in 1958 for just over $31,000. He drives a modest car, avoids luxury yachts, and famously stops by McDonald's every single morning for a breakfast that costs less than $4. He completely rejects lifestyle inflation. In a world that screams at you to spend every penny you earn to project an image of success, Buffett understands that true financial freedom is found in the gap between what you earn and what you spend. He treats every dollar, or, in our case, every pound note, as a worker that can be sent out to harvest more wealth. When you constantly upgrade your lifestyle to match your rising income, you are effectively firing your best financial workers. By keeping your expenses stable and funneling your surplus cash directly into income-producing assets, you turn your income engine into an absolute wealth machine. Let's recap the entire historical blueprint so you can begin applying it to your own life today. First, channel your inner young Warren and maximize your primary income engine through relentless side hustles, upskilling, and career progression. Second, adopt the value investing mindset by focusing on the real, intrinsic value of what you buy, refusing to get caught up in market hysteria. Third, look for compounding assets with strong economic moats, high-quality global companies that dominate their respective spaces. Fourth, understand that time is the ultimate multiplier. Give compound interest the decades it needs to turn your small monthly contributions into an absolute avalanche of wealth. And finally, reject the consumer trap of lifestyle inflation, keeping your foundation solid and your expenses disciplined. Warren Buffett's history proves that you do not need an extraordinary starting point to achieve extraordinary financial success. You simply need an extraordinary amount of discipline and consistency. If you are ready to stop chasing get-rich-quick schemes, adopt the proven wealth-building principles of history's greatest investor, and take complete control of your financial destiny, make sure to hit that subscribe button right now and join the community here at The Money Mad. We break down the timeless rules of money, investing, and wealth creation every single week, specifically tailored for UK residents trying to win the money game. To help you get your own compounding engine started, we have compiled a list of our highly recommended, low-cost UK investment platforms, tax-efficient tools, and high-yield savings accounts down below. Click the affiliate links in the channel description below to explore them. Utilizing those links costs you absolutely nothing extra, but it directly supports The Money Mad and allows us to keep producing these deep dive guides for you. Thank you so much for watching, stay disciplined, think long-term, and we will see you in the very next video.